Hello, my name is William Dinizio. Along with my fellow Burkenroad analysts, Lyric Lee, Michael Retta, Michael Sander, and Fan Wu, we have conducted an equity research report for EPL Oil and Gas over the course of this semester. The following is a video representation of our report. Company description: EPL is an oil and natural gas exploration and production company. The company was founded as Energy Partners Limited in 1998 and changed its name to EPL in September of 2012. EPL operates along the coastal shelf of Louisiana within 100 miles of New Orleans. The company went public and was listed on the New York Stock Exchange in 2000. In May of 2009, EPL filed for Chapter 11 bankruptcy and emerged in September of 2009 with a revamped business strategy that focused on creating an oil-heavy asset base. Acquisitions are the key to growth for any E&P company. EPL strives to acquire low-risk and oil-heavy legacy fields in its core competency area of the Gulf of Mexico shelf. The company attempts to make these acquisitions to increase oil and gas production and revenues while reducing exploration, development, and operating costs. EPL has recently doubled its proved reserve through a $550 million acquisition from Hilcorp. Industry analysis: the process of searching, drilling, and recovering crude oil and natural gas formed the E&P sector. After 2009, the E&P industry is focusing more on the production of oil than natural gas because the historic low prices of natural gas make it less profitable than oil. Oil provides much greater profitability because the demand is more inelastic. Multiple macroeconomic factors affect the price of oil, such as US GDP, currency exchange rate, supply and demand in developed and emerging nations, and OPEC. The Gulf of Mexico is home to more than 1,000 oil and gas producers continually seeking new reserves, employees, and continuing business. This competitive landscape, along with the high-risk nature of the E&P industry, gives no guarantee that any company will survive. The large demand for oil and gas and fixed size of the Gulf of Mexico and reserve quantities makes the E&P industry particularly competitive. Peer analysis: EPL's peers include numerous independent oil and natural gas E&P companies. We selected 4 companies with respect to similar business drivers, location of operations, and market capitalization. They are Energy XXI, McMoran, Stone Energy, and W&T Offshore. EPL has a PE ratio of 10.9, the highest among its peers. This indicates that investors are more confident about the company's future growth compared to its peers. EPL is the second lowest price-to-book value of its peers at 1.55. This may indicate that the market does not value EPL's assets as highly as the assets of the company's peers. EPL's enterprise value to EBITDA is similar to that of its peers. This indicates that the company is valued well proportionally to its peers. EPL has a debt-equity ratio of 41.6%, which is lower than every other peer that we've selected, indicating that EPL does not finance new growth prospects with as much debt as its peers. Risk analysis: we categorized EPL's risks into operational risks, financial risks, and regulatory risks. EPL faces operational risks mainly from oil and gas price volatility and weather. Over 90% of its profits come from oil, so the volatility of oil prices may adversely affect its profitability. Because of EPL's concentrated operations in the Gulf of Mexico region, the company bears unique weather and geological risks. The Hilcorp acquisition required EPL to utilize debt to finance the acquisition, which further increases the leverage risks and liquidity risks of the company. Finally, as an offshore E&P company, EPL bears regulation restrictions such as limits on air toxic emissions. The regulatory risks cause substantial operating costs, which adversely affect the company. Using the Z-score analysis, we can conclude that EPL is at risk of financial distress because the company scored 1.45. Whether EPL can withstand this depends on its risk management and post-Hilcorp acquisition operations. Our analysis of EPL took into consideration 4 key issues that will influence the company's growth over the next 12 months. These 4 issues are Hilcorp acquisition, hedging strategy, efficient and strategic capital reinvestment, post-bankruptcy acquisition strategy. The Hilcorp acquisition. On September 17, 2012, EPL announced the $550 million Hilcorp acquisition that would nearly double EPL's proved reserves. 40% of the Hilcorp acquisition's reserves are proved developed producing 10,000 barrels of oil equivalent per day. EPL will finance the acquisition with a combination of $550 million in new debt and cash. Management's decision-making will become increasingly important because of this substantial debt increase, but their disciplined approach to business has been the driver in creating this opportunity. Hedging strategy. EPL protects itself from the downside risk of lower commodity prices through its hedging strategy. The company protects a portion of its production from lower commodity prices using derivative transactions. The majority of this hedging is through fixed price swaps that lock in a specified price for a certain production volume. The remaining hedging is done through collars that allow for EPL to sell at market prices within a predetermined price ceiling and floor. We feel that this hedging strategy gives EPL sufficient downside protection because it will protect 62% of EPL's anticipated oil production in 2013. It does not protect as much of the company's anticipated gas production. However, the high price of oil and low price of gas results in the majority of EPL's profits deriving from oil production. Efficient and strategic capital reinvestment. Through the optimizations of acquired fields, EPL typically decreases lease operating expenses by 13% and increases production by 69%. These optimizations can be as simple as replacing a valve on a rig and characterize management's strategy of seeking low-hanging fruit to increase profitability. EPL also places a large emphasis on using state-of-the-art geosurveying technology. These efforts have rewarded EPL with several million barrels of oil and probable reserves that were not accounted for before acquisition. Geosurveying has allowed the company to discover additional pay sands of up to 1 million barrels of oil equivalent in its operating regions. Post-bankruptcy acquisition strategy. Since emerging from bankruptcy, EPL has adopted a disciplined acquisition strategy that has fueled inorganic growth. This strategy is typified by aggressively seeking high-quality and low-risk oil-heavy assets in its core competency area of the Gulf of Mexico shelf. By seeking oil-heavy assets in areas EPL has significant prior experience, the company has been able to capitalize on high oil prices and minimize risks and costs through management's experience. As a result, the company has been able to grow EBITDA 46% year-over-year in 2010 and 50% year-over-year in 2011. EPL stock price as of October 26, 2012 is $19.81. Since its bankruptcy, EPL stock price has increased steadily. In the past 52 weeks, it has traded as low as $12.36 and as high as $22.41. The 12-month price target that we give EPL is $28. This represents a 41% increase in stock price. We use two valuation methods to get the price target, PV10 and relative multiple of enterprise value to proved reserves. We predicted EPL's future 10-year production and chose the 5-year PV10 valuation method because the farther you predict into the future, the greater the chance for uncertainties. For relative multiple valuation methods, we used third quarter 2012 data. We then weighted the results of PV10 and relative multiple valuation methods equally and came to the price target of $28. As a result, we give EPL a market outperform rating. The Burkenroad reports are produced solely as a part of an education program at Tulane University's Freeman School of Business. The reports are not investment advice, and you should not rely on them in making any investment decision. You should consult an investment professional and/or conduct your own primary research regarding any potential investment.